Invite Mr. Thillai Rajan. So Mr. Thillai Rajan is a professor in the Department of Management Studies at IIT Madras and is currently an associate at the Musavar Rahmani Center for Business and Government, Harvard University. In 2017, he co-founded Vynos Venture Engine to address the pain points of the early stage entrepreneurs. This venture is currently incubated by the IIT Madras Incubation Cell. Now, since 2009, Thillai Rajan has been instrumental in publishing the much admired annual India Venture Capital and Private Equity Reports series. So far, 9 editions of the report have been published. Since 2016, this report has been released in the TiECon Chennai conference, which is normally hosted by TiE Chennai. So, ladies and gentlemen, please put your hands together and welcome Mr. Thillai Rajan.
Thank you, and good evening. It's been a long day, I think, for many of you, and at the end of a long day, and to come here and be a part of this entrepreneurship-related forum, and coming here and then trying to see what's best can be done to kind of further the entrepreneur ecosystem in India. It's truly phenomenal. So thank you for coming, and thanks to Badri, thanks to TiE for giving me this opportunity. So I will try and make it a little bit interactive, and at any point in time, if you want to raise a hand, please raise a hand. And I'm going to be talking about things which is little at the 20 feet level, 20,000 feet level. And Lalit had given a fairly hands-on coverage of some of the important topics, but I'm going to talk at a slightly different level. It's a blank slide, but I just wanted to kind of, what is the most important thing that we all feel in modern day life today? Any one or two answers? Okay. So I think predictability is becoming a very, very important factor. Everybody wants predictability, right? Across various dimensions and platforms. I'll give you some examples. Let's say, for example, Google, right? So Google, when it started maybe 10, 15 years ago, it was a very simple search engine, right? But today, you type the first letters and then you have so many options being thrown up, right? Second letter, the option is being thrown. And today it says that if you're not in the first page of the Google search engine results, then there's no way people are going to see you, right? So much of predictability that is being built in to the search engines. Second example is maps. Right? I think today it's become very ubiquitous to many of us that when we go out, we just look at the map, look at which of the routes we have very less traffic, which makes us to take our destination faster, and so on and so forth. We don't actually measure, right? We don't actually measure what the Google says, what we actually experience, but ultimately we have some comfort when say that, okay, there seems to be lesser traffic here, can you take this route? Right? The third example, the cabs. Today we know, okay, it is coming in 1 minute. Do we measure it? We don't measure it. But the fact that it's coming in 2 minutes, shows it's coming in 2 minutes, gives us a lot of comfort. Right? And then we don't only know the time, it shows how much you're going to pay. Right? Great amount of predictability. Earlier we don't know, right? When you get into the auto or when you get into the taxi, we are at the mercy of the taxi driver. Right? We absolutely have no clue how much you're going to pay. Right? So not the time that we get the cab, not the amount that we get to pay the cab. We also today get a prediction of how long is it going to take for the journey. Right? So see the kind of, increasingly becoming demanding on predictability. And so how are we able to get this predictability? We are able to get this predictability by trying to decipher more and more complexity. When starting from the time, right? Let's go back to science, physics. So initially we said, there is an atom, and then people looked at the nucleus, and then people looked at, within the nucleus there is a proton and a neutron, then people looked at electron, then we look at subatomic particles. So people are trying to get an increasing level of complexity. Why? That gives you more and more predictability. Right? So similarly, as we try and decipher, we started with a cell, then from the cell we went into we get into DNA, then from the DNA we get into various cellular organisms, and from cellular organisms we get to the molecular level. So increasingly we all try and get into as much minute details as possible with an objective of understanding the complexity, which will help us to be more and more predictable. question that we have been trying to kind of address in the entrepreneurship space. So for example, this is the kind of funding trends that we see in startups in the Indian scenario. Right? So for 875 startups that get funded, only 75 get some first round of funding, right? From external investors. So when you say angels or incubators or accelerators, so out of 875, we have only 75. That's a very poor ratio is what we felt. So to give an example, if you take this ratio from some of the other developed countries, it's close to between 1/3 to about 50%, right? But in India, we have about 8%, 9%, 10%, so the ratio is very, very less. So is there some way that we can do? Can we increase the predictability of funding to enterprises that actually get formed? So it's both a demand side issue and a supply side issue. So demand side, we need to have, the credit is that we need to have better companies so that they are fundable, right? But we also try to supply side problem. Right? Is there some way that we can find out which kind of investors and which kind of companies are better suited to each other and see if you could, because it's a financial market out there, and for each and every company that could be a potential investor, it just matters in terms of how do we identify who the potential investors in the market? Is that something that we can do? So that's a challenge that we wanted to focus on. That's what we worked in my venture. And what we're going to do is, I'm going to share some of the trends that we have seen in the last many years that we have worked in this sector, which ultimately helped us to understand this problem of how can we estimate, how can we predict venture being funded a lot more closely than what we have been able to do so far. Right? So, but as we go in each and every round, for example, if we look at the second round of funding, the probability increases, right? So from 75 to 15, which is about 1/5, from 15 to 5, which is 1/3. Right? The first is the most important thing, and is there something that we can do for ventures to get into this early stage funding? So I'll give you some, we can feel very happy about the way in which the Indian ecosystem has grown. Right? So if you look at the startup deal growth, it's grown more than 10 times. I mean, I don't know if there anything, any other country which can kind of, boast of this kind of a track record. So we talked about, let's say, close to 600 deals in 2005-07. Now it's become more than 7,000. Right? So that's the kind of growth that we are seeing. So when growth happens, what happens? When growth happens, there is complexity. Right? So if we are not in a position to kind of leverage this complexity and be able to say something, then I think we probably lost a very good way to kind of harvest this entrepreneurial energy today. So the government obviously is playing its part. So this kinds of gives a, is it visible at the back? So this kinds of gives a list of state governments that have kind of enacted startup policies. Right? So today everybody is getting into the bandwagon. So starting from 2007, there is very little, right? So the stars indicate the year when the state governments first enacted the startup policy. Right? So look at 2016. So there's almost practically about 70% of the states in India have started, getting on some startup-friendly policies and so on. So it's a climate is very ripe to be able to kind of succeed. Right? So policy environment is always what I say is like a vitamin, right? Absence of it is a problem, but the presence of it need not always guarantee success. Right? In case policy and practice happens very well, there can be a roaring success like we see in the case of maybe Kerala and Karnataka. But having a good policy, for example, we have a good policy in Jharkhand, in Uttar Pradesh, but then that does not necessarily lead to success because the other ingredients are missing. But nevertheless, one important thing that many of you might notice is Tamil Nadu does not have a startup policy as yet. There are only small pockets across the country where the startup policies are very comprehensive. So for example, if you really look at the dark green ones, right? Look at India, only these 5, 6 states have a very comprehensive policy. The rest of all, it's fairly barren, right? Jammu and Kashmir, the entire northeast. So Tamil Nadu is kind of, it's still not really the dark green, but it's somewhere there. But I don't know how many of you are fans of Rajinikanth, right? Fans of most of it, right? So like that's what he mentioned, right? So later on the latest hour, right? So today they are planning to create a policy, and I happen to look at the draft policy that is being circulated, and I think it's pretty comprehensive. It's probably one of the best policies that I have personally seen among the different state government policies on startups. And remember, I think we are looking at an election maybe 2-3 years now, right? So obviously the government is going to put all its might in making this policy fructify. So the timing is very right for, I would say, startups being set up in Tamil Nadu. So this gives another snapshot in terms of how do we see startups and the SMEs. Right? So when you say startup, traditionally people mean innovation, technology driven, and then when you look at the SMEs, the traditional hard asset driven, right? Machinery, equipment, manufacturing, those are the kind of things. So the landscape is a little different. For example, Tamil Nadu, which is actually have a very strong role in the traditional SME sector, right? That's not really fair as much if you really look at the startup sector. Right? But if you look at Karnataka and Maharashtra, which is not really the traditional SME sector strongly well. Right? Gujarat, which is again reasonably strong in SMEs, it's not been done well in the startup kind of sector. So the way in which the states have approached this topic has been very, very different. And today, our state is kind of trying to see if they can transform our traditional SMEs kind of strategy to become more innovation and technology-driven startup. Okay, so now we'll kind of shift gears and look at a little bit about the startup trends that we see. I mean, this is a very nice looking graph. Right? So the average age of startup while angel investment. I mean, I'm going to focus largely on angel investment because I think that's where we have kind of focused most of our work on, and I think it's very important as well to understand because many of you are looking at angel investments in this audience. So right from about 6.15 years in 2015, it's reduced about half. So the propensity to actually get angel investments is gradually increasing. Right? Companies are able to get angel investments very fast, and that's a good news, right? So people are willing to take, investors are willing to take a higher risk, and they are willing to invest at the early stage. So that can't be a better news for entrepreneurs. But what's happening and what's critical to be aware is what kind of increases the success rate of getting funded. So what we did was we actually took a bunch of companies and then separated them into which have been funded and which have not been funded, right? And then we made this plot. Right? So just look at this red line, which shows the proportion of companies that get funded in different stages. Right? So this is the inflection point, right? This is the inflection point. Right? When you are able to launch a beta product, so at that point in time, the probability of getting funded increases dramatically, right? So this is basically the companies that have not been funded. It's kind of very steady story, but when you really have a beta launch, that is a pretty clear inflection point in terms of the funding. So the chances of getting funded increases tremendously. So now it actually creates a clear implication for many of you. When should we actually go to an investor? What is the right time to go to an investor? You would probably go to an investor when your probability of getting funding is higher, right? And when would that be? So that would be at a time where you have probably something launched and ready. So now let's look at it from the investor side. What's happening? So the investors, a lot of investors, the angel investor segment are going tremendously. So much of investment money is coming in, but what's actually happening is the investors, what we call having an itchy finger. They are not being patient, right? They want to quickly go ahead and make an exit. So what we did was we looked at the average duration of investment that the investors have in the company and tried to map it over time. So just look at in 2000, average investment duration was about 7 years. But look at 2016, right? People are, somewhat close to 2 years, right? People are wanting to exit quickly. The average duration is coming down steadily and gradually. So what does it mean? So this puts additional pressure on the investor, right? This puts additional pressure on the investor to be able to give an exit. And that is something when you're taking money you have to be cognizant of. Let me give you another graph which is slightly. While the investors are trying to get exits early, exits are taking more time. It's kind of that means that there's a lot of difficulty in getting exits. So average time to exit has been about 4.68 years, and then it's kind of dipped down. But then from 2010 onwards, it's been steadily increasing, right? An investor is taking more and more time, though not substantial, but it's taking more and more time to be able to get an exit. So that is the investor wants to exit quickly, but the environment is not allowing, it's not creating a condition where the investors are able to exit quicker. So obviously there is going to be a lot of pressure on the investors. And there is going to be a scramble, and people want to exit as quickly as possible at whatever opportunity that they're going to get. And what it would mean for the entrepreneur is something that you could all guess.
Can I interrupt, sir?
Yes,
Can I
sir.
interrupt? What is the fantasy? Why would the investor want to exit quickly? That is something that I find. If the investor has put the money in a good startup, they would rather keep the money there as long as the growth flattens out. Why is that there is a...
So we're talking about an average investor here. So what result that I have not shown here is there is a very clear relationship between the average investor duration and returns. Right? So the tendency is that, surprisingly, as the investor duration increases, the returns reduce. Right? The highest return happens when the investment duration is between 2 and 3 years. They stay invested for more longer, the returns drop. So probably that will be the reason.
For the angel investors.
For the investors.
Is it for all the investors or is it only for the angels?
That's for all the investors.
No question here.
Oh,
The
sorry,
previous-
so can we take the questions after the presentation? So we're running out of time, sorry. They will be on the banner so we can ask questions.
I don't know how many of you there was a WhatsApp joke being circulated, right, some time back. So there's this Vandelur Zoo, and then it's a special occasion, and then they all said that the zoo is open free. Right? Every week please come, every week please come. So people said, oh, how come the zoo is open and free? And then it's a great opportunity to see free, of course, a lot of traffic they went in. And then after that they said they closed all the entrance gates, and then they put down all the wild animals out of the cage. And then they said, if you want to exit, there is a price. So there was a mad scrum for exit, right? So everybody wanted to exit. So that's probably what we're seeing here. So entry is very easy, but investors get stuck with investments. Then they kind of that is paranoid, and then they want to exit as quickly as possible, which may not be a good thing. So now again, let me shift track a little bit and then focus a little bit on Chennai and see how Chennai is. So this basically is looking at various cities. I think it may not be visible. So Bangalore, Mumbai, and Chennai. So the trends are not very different. Right? The trends are not very different. I mean, we have a very homogeneous, unlike in the US, where, let's say, for example, Silicon Valley's technology, it's fairly homogeneous. Very, very minor differences. So for example, three are the market segments are, let's say, for example, software and internet services, and then you have internet marketplace and e-commerce, then you have fintech and consumer products and services. Right? These are the large sectors that end up getting investment among the 14 categories that we have found out here. Right? And this remains very similar across cities. Like if you look at either Delhi, Bangalore, Mumbai, and Chennai, they're more or less the same. I mean, there are some slight differences which we'll come to, but otherwise it's the same. And the average age of startups at the time of receiving angel funding, I mean, you all know that Chennai is a very conservative city, and that's getting reflected here. Right? So Chennai, among all the cities, among all the major cities, has the highest age at the time of getting funding. So that means investors are looking at more mature companies, investors are looking at companies with a lot more track record before they invest as compared to what the other cities are. Right? So if you try and compare with your friend in Bangalore and say, oh, they are getting funded much quicker, I mean, the ecosystem is very different. Maybe we have to be prepared to the fact that in Chennai, the nature of investors are very different, and therefore we'll have to approach it accordingly. And this also shows the average angel investment that is that's been received in Chennai. Again, Chennai gets investments much later, but they also get average investments that are lower than what the other 6 cities are able to provide. Right? So Bangalore is probably one of the highest, 45.66. Right? Is the average round investment amount in an angel round. It's about 4.5 crores. But Chennai, it's less than 3 crores. Right? So the segment that gets angel funding in other cities and the segment that's probably getting angel funding in Chennai is very, very different. It's probably to do with the kind of angel ecosystem that is there, the kind of investors who invest, and so on. So what determines the value of early stage So surprisingly, we find the external environment plays an important role, right? So it's kind of quickly surprising to say which way the wind blows. Right? So here we have looked at various factors and the weight that each of these factors has on the firm value. Right? So the first one that we want to talk about is like the total deal value. Right? So how much angel investment has happened in the previous quarter? That is the total deal value, right? How much angel investments happened in the previous quarter? So this actually is significant mood swinger, right? So much of the valuation depends on how much has happened in the economy, how much have people invested in the past, right? That is one. Right? Then we also have the overall economy. If the overall economy is booming, people are more interested to invest. People are willing to kind of give a more value. And then we have technology, right? So look at the weightage, right? So the total investment in the VC, the economy, and then we come to the sector. Right? Sector is actually not playing a very, very important role at the early stage. And then we look at the business model. Right? What are those that are actually looking at pulling down the valuation? Let's say, for example, whether it's a city, what kind of city you are in. Let's say, for example, this basically indicates a tier of the city. If you are from a tier 2 city, that means in Tamil Nadu, anything other than Chennai, if you are in a tier 2 city, the probability of getting a value lower is very high as compared to what you would have got if you had been in a tier 1 city. And this is the biggest, puller, let's say average deal value. Right? If the average deal value is reducing as compared to what was in the previous quarter, then again, it could have a negative impact on valuation. Right? So these are some of the important factors that influence valuation, but what we think is important to know is, okay, all of these are important, right? All of these are important, but at the early stage, the biggest influences has been what's happening in the macroeconomic context. The current location of angel investors, Chennai again, it's not nothing much. I think if everybody here becomes successful entrepreneurs and become angels, I think this proportion will improve very quickly. Chennai today, if you look at it, it accounts only about 1/8 of the total startups in the country. In terms of companies that get funding in Chennai, consumer products and services are the ones that are actually getting a lot more funding. Then comes software, internet and services, then come tech. Real estate are all some of the bottom ones, but consumer products and services seems to be one that's getting maximum funding. Business model classification, if you classify into B2B, B2C, and B2B2C, again you find the conservative nature of the city asserts itself is what I would say. Among all the cities, Chennai has slightly lower amount of B2C companies, which traditionally are considered a little bit more riskier, more intensive in terms of investment. And B2B, Chennai is probably one of the highest proportions of ventures that get funding. And when you kind of look at the positives, investor and non-investor startups, the biggest positives that investors see is basically in terms of market size, right? And then the product strengths and uniqueness. So these actually play a very important role in terms of attracting investment. That doesn't mean to say that companies that did not get investment did not have this. Companies that did not get investment also had positives, but then they were relatively lower. As we have seen earlier, now there's a very, very small, thin line of difference between companies that got investment vis-a-vis companies that did not get an investment. Right? So the margins, if companies are able to perform better at the margins, I think they will be more successful in getting an investment. It's not that absolutely companies are bad and they did not get, but the line was very, very thin between those that got invested and did not get invested. I'll move more of this and share this last slide. This basically is a sample taken from a very large angel network platform. And we look at companies that got invested vis-a-vis that did not get invested. Look at the company stage, post-revenue and pre-revenue. Companies that got invested, but largely in the post-revenue stage. They have some revenues to show. Right? Majority of them who got invested had revenues to show. And the investment requirement was lower actually, right? When they were in a stage where they had revenues, but the investment requirement was lower, so investors are a lot more comfortable. The revenue run rate was higher. And then, this is important here, right? The reference from angel investors, right? So, any deal that actually has a reference has a higher chance of getting funded. So much of the proposals that reach the angel investor platform, they have what is called as a directly. You directly send a mail, right? So majority of them, like they directly send, but then there is very little of them getting funded. Right? So before we actually go ahead and start making features and so on, let's not follow this spray and pray kind of a culture. Right? Let's be targeted, and when you target which investor are going to approach, then the results are going to be a lot better. And so in our exercise to be able to kind of improve the predictability and increase the chance of getting funded, we have done a variety of solutions which is available in the platform. So I'm not going to talk about this here, but whatever we thought about from a research perspective, we kind of translated into some products and services that can be useful for entrepreneurs. So thank you so much. Can anybody able to decipher what is here? So this essentially is the list of keywords of Chennai startups, right, that we kind of put together. And we have large database of Chennai startups that have been receiving angel funding. So we created a keywords of all these companies, and so this is a collage of the keywords that we put together of Chennai companies. So thank you so much, and I suppose now is the time.